InFi, Episode 6.
Welcome to InFi, the Future of Finance, hosted by American economist and author Dr. Robert Murphy. Each week, tune in for dynamic discussions with business pioneers about emerging trends in finance, life insurance, asset management, technology, and more. Now, let's talk the future of finance.
Hey, everybody. Welcome back to the InFi podcast. Today, I'm very happy to be speaking with Jeff Deist, who's the general counsel at Monetary Metals. I know Jeff personally, but let me read you the official bio they have for him at Monetary Metals. Jeff spent 10 years as president of the Mises Institute, where he wrote hundreds of articles and delivered countless speeches on topics of monetary policy, gold, and central banking. Prior to that, he worked on Capitol Hill as chief of staff for Congressman Ron Paul. He previously worked as an attorney in law firms and public accounting firms, specializing in private equity, mergers and acquisitions, and tax. Jeff holds degrees in law and taxation. So I have known Jeff for a long time, well, at least the 10 years he was president of the Mises Institute is how I got to know him very well. And we knew of each other before then. We co-hosted the Human Action podcast that was housed at the Mises Institute. So Jeff ran it, and I joined him as a co-host, and now I took that over when he left to take his new spot at Monetary Metals. This conversation, we spend a lot going into the mechanics of what they're doing over at Monetary Metals and the different, models or business approaches for various clients that they have. I want to be clear, it probably would go without saying, but let's not take a chance. We're not here giving a commercial for Monetary Metals. When I learned how they were operating, I thought, oh, that's a very interesting innovation. The idea of holding gold as a hedge against inflation, that's what people have been doing for a long time. And yet over at Monetary Metals, they've come up with innovations in that to try to improve the outcome for their clients. And so that's kind of what we're all about here at Infineo, is using modern technology and new approaches to revolutionize the financial sector, even like in the case of life insurance, something that's been around for a long time. Okay, so again, it's just letting Jeff explain what they're doing, because that's the sort of thing we're going to be unpacking in this episode and future ones, letting people who have intriguing business approaches, especially innovating in the financial sector, are going to come on the show. Beyond that, I asked Jeff his thoughts on the general landscape. Again, he's a very savvy commentator, chief of staff for Ron Paul, so you know where he's coming from politically. And the current landscape is definitely needing someone with his background and views to be giving guidance to the public. So with that, here's my conversation with Jeff Deist. Jeff, welcome to the InFi podcast.
Hi, Bob. It is good to see you.
Well, I think a lot of our listeners probably know your background, and I would have given some, of course, in the recorded intro there. But for those who are unfamiliar with you, can you just maybe give a broad overview of just some of your background and then how it is that you ended up in your current spot?
Well, that's a good question. I have a background as a lawyer, particularly in tax, particularly in mergers and acquisitions. The company I work for now, Monetary Metals, we do a variety of deals, both gold and silver and platinum bonds and leases. We do these in a variety of jurisdictions in the US and Canada, around the world, increasingly in the Middle East. So presumably having a background in transactions gives me some leg up on this job. I spent about a decade at the Mises Institute, which a lot of your listeners will know is sort of ground zero epicenter for the Austrian economics program. And before that, I was at one of the big four accounting firms for many years as an attorney. I have some background before that as an attorney in private practice at a couple of tax firms. And I also had a stint working for Dr. Ron Paul up in Washington, D.C. in his congressional office. He's someone I met as a very young guy. I was still in high school in 1988 when he actually ran for president on that Libertarian Party ticket. And he came to a hotel in my town, and I met him at that time and stayed in touch with a couple of people who were working for him at the time. So that's, in a roundabout way, how I got interested in money and economics, and hopefully a greater degree of freedom in both categories.
Well, sure, yeah. And I thought it would be useful for you to spell out that arc, because I guess one of the continuing things throughout it is just you working in, with terms of money and finances, understanding the connection between hard money and personal liberty. And so that's what part of what I guess what you guys are doing now, like your whole firm. I know, I think all the major employees there, and they're all steeped in that tradition as well as understanding, the historical importance of gold and so forth. Can you talk a little bit? Cause the business model for monetary metals fascinated me when at first I didn't fully understand it, but can you just talk a little bit about, what is it that you guys do over there?
Well, it's interesting. If you think about physical gold, there's about $13 trillion worth of it laying around at the current per ounce price of $1,930. So if you take all the gold in the world, physical gold, held by sovereign governments, by central banks, by individuals, by companies, in sock drawers all over the world, it's about $13 trillion. And most of it's just sitting around. It's doing nothing. And a lot of it, people are even paying points to store it or keep it in a safe deposit box or keep it in a private vault to insure it, all these things. And you think, well, governments have beaten down gold and not allowed it to be used as money any longer. And so if you were to ask a central banker if gold was money, he would say, no, it's a precious metal or it's a commodity asset or something like that. But he or she would not say it's money. Okay, well, in the legal landscape in which we live in the West, I guess that's true. But nonetheless, it's very stubborn. It retains this monetary aspect to it. And I think that explains why central banks continue to hold it, regardless of what they say. In other words, Ron Paul once asked Ben Bernanke, why does the Fed hold gold? Why does it continue to hold gold? And Ben basically said, well, that's a relic. It's a remnant of past practice when we had a gold standard. We had some measure of gold convertibility. But I think it's interesting that they haven't dumped it all since 1971. And so gold still has this moneyness to it. And as a result, I think the idea behind our company and our founder, Keith Weiner, was, hey, why can't we put some of that gold to work? Why can't it be used to collateralize transactions, to collateralize insurance companies, to provide inventory for gold or silver jewelers for manufacturing or industrial uses? Why can't it be used in bonds for gold mines or refiners that actually produce finished gold bullion, for example? And so all these questions came to mind, and he started a company based on this idea. So we provide, oftentimes in the form of a lease, we provide gold or silver to a user, to a jeweler or an industrial user, and they have that as their inventory. So they don't have to go spend their cash on inventory. They can get gold or silver from us in physical form. They also can use that cash that's then freed up from inventory to do all kinds of things like make payroll or invest in CapEx or whatever it might be. They don't have to tie it up in inventory. And then also they know their cost for the period of the lease. So let's say it's a 1-year lease. Let's say it's 10,000 ounces and we charge them 7%. They know that over the course of the lease, they're going to owe us 7,000 ounces in addition to returning.
Can I stop you right there, Jeff? I just want to underscore, because I'm sure a lot of the listeners just automatically in their head, when you said that, assumed you meant looking what the spot price of the gold or the silver was, and that's what no. When you say they're agreeing to the terms of the lease at 7%, this is the units are all in weights of the metals.
Yes, we are quoting and paying our leases to our investors in ounces. So if they have a 10,000 ounce lease with us at a 7% lease fee, then they're paying us 700 ounces additional when they repay the 10,000 ounces. So they know up front that they simply have to replace those ounces. They don't have to worry about the cost of gold going up and down because they're going to be buying it at market price whenever they purchase it to return our inventory or to pay interest to us. And so as they produce a product, let's say a jeweler produces gold jewelry, they take that out of our inventory at then market price. They produce it, sell it at then market price, replace the 1 ounce, let's just say, at then market price. So they don't have to worry about the price fluctuation during the year. Whereas if they simply use their own cash, put a few $1 million into a couple several thousand ounces of gold, and then during the process by which they were producing jewelry, gold went from $1,930 to $1,500 or something, all of a sudden their inventory would take a huge hit, the value of it. And so they would have to have a big write down for accounting purposes on their inventory. So it also, not only do we provide a way for them to free up their cash, but we also provide a level of certainty for their cost of inventory for the period of lease.
And again, just to make sure that, because this is something, the reason I'm stressing this is for whatever reason, it wasn't clicking with me when I first heard the model, because I was thinking it's not like sheep. Like I get how if you have 100 sheep and then, you tend them right and they physically multiply. But with this, but yeah, it's because the people who are taking out the leases are in, they use the physical product, like you're saying, so that the fluctuations kind of cancel out. That yes, in one sense, like, oh, I thought I had to pay back 700 ounces when gold was 1,900, and now that it jumped up to 2,500, that's more expensive in dollar terms than I thought. But like you're saying, by the same token, okay, but what they're sitting on also appreciated by the same amount, and so it kind of cancels out.
If they're selling an item of jewelry that has 1 ounce, presumably their sale price on that item has also risen with the gold price.
Right.
And Bob, gold can't reproduce itself like sheep. It just sits there. It's a shiny rock.
That's what I had to understand.
Even with 3D printing, we can't make gold.
Right. So, okay, so you're explaining, and then like similar, like another typical customer for you on that end of the business would be like a mine or something. Can you explain how that works?
That would be more of a bond situation. Let's say a mine needs to raise $10 million. So they want to go for operations. So normally they would go out into the financial markets and either borrow that and pay interest on it from a bank, or they would issue a bond and pay interest on the bond to bondholders. So instead of doing that in cash, we're simply able to do that in ounces of gold that they need for their operations. And then we can also charge them interest in gold so that, again, they're in the same situation as the jeweler using it for inventory. They don't have to worry about price fluctuation. And so the point here is that, especially with a gold miner, I've spent a fair amount of time looking at gold mining stocks, which tend to be smaller companies. There are big ones, but the smaller ones tend to be where everyone thinks there's a huge upside in the price. And there's a lot of consternation over the fact that gold mining stocks don't necessarily track the rise and fall of the spot gold price. And a lot of them tend to struggle. They're undercapitalized. Sometimes they go out of business altogether. And so it just strikes me that we're trying to put the gold that's already up here, that's already been mined, that's already been refined, that has already been converted from doré into bullion, whatever it might be. We're trying to put that gold to use. So you don't have to go invest in a miner. You don't have to go find out where it is. You don't have to worry about a mine being nationalized or being undercapitalized or anything like that. Let's take the gold that's already here, $13 trillion worth of it, laying around unused. And even the most ardent monetarist, the most ardent opponent of the gold standard, even the most hardcore MMT advocate, for example, would admit that gold is an asset, that gold has a price, and that I think in their heart of hearts, they'd admit that it's kind of a financial asset, that it has an element of moneyness to it, even though we've gotten rid of the gold standard and any notion of gold redeemability in the West. So we're trying to use gold, trying to put it to use. Everybody out there right now in capital markets is desperate for money. If the IPO market has cratered somewhat, the startup market, the venture capital market for small companies, 20 years ago in Silicon Valley, it was not nearly as difficult to raise equity capital from investors. But if you talk to people in that world, if you talk to people in the world of private equity, venture capital, family offices, et cetera, they will tell you that just as with the commercial bank lending, private investment, I wouldn't say it's dried up, but it's a lot more difficult. It's a tougher environment than it was just a few years ago. And so we're hopefully going to provide an alternative to that using an asset that's already there. Again, this gold is laying around. So I hope I'm not going on too long. Obviously, I have an interest in this business, and I'm more animated than most about it. But I do think that it's a big sleeper.
Yeah, well, no, it's the other way around. I was actually going to say, forgive me, I want to push you to have you elaborate more, because for whatever reason, it just wasn't clicking with me until I had another conversation with one of your guys And then I was like, oh yeah, duh. So you're right. I jumped the gun. I was switching from the leasing to the jewelers part of it to the mine. Let's focus on the leasing. So we understand from the jeweler's perspective that, yeah, they have a bunch of gold that they're sitting on. They're turning it into, they're getting the rings or whatever, things they got to do to supplement the raw gold with, to turn it into the finished jewelry item for the ultimate customer. And so, yes, we've explained from their perspective why it makes sense to work with you guys because.
Right.
Yep.
So let's say they pull 1 ounce out,
Mm-hmm.
and make a 1 ounce piece of jewelry from it. Well, when they take it out and sell that, if the price of gold's gone down, they sell it for less, but they immediately replace that ounce with us at that lower market price, which they can go out and get from any number of big bullion dealers. So they don't have to worry about that price fluctuation as they go.
Right. So that, again, we get why that would make sense. And then now though, so where you guys are getting the gold though, from that person's perspective, like the pitch to that person is like, hey, you're sitting on stores of physical gold, you don't trust Wall Street and whatnot. We get it. Like you have that as a hedge there as the ultimate safety. But instead of it just kind of sitting in your safe deposit box or in a safe in your house, earning a 0% growth, if you lease it through, with us as the middlemen, then you get, a growth rate measured in physical terms. And that's really, so it's not speculation.
Yes.
It's just, you like gold. Do you want to have more next year? And this is a way that, and again, it makes sense with the business model. It's not, really speculative or something in a conventional sense, and of how you can take your 10 ounces and turn it into more than 10 ounces.
Sure.
10.7.
And the big knock on gold has always been it doesn't pay a yield. It doesn't pay a dividend. It just sits there. Now, you could say the same thing about holding cash. And we like to think that gold is kin to cash almost, that it has a moneyness, and that in a free market, it would be widely accepted and circulate as money in some kind of form. Now, that might be in a digital form, but backed by gold. But nonetheless, that's not the world we live in. There are laws about what you have to use for money and what you need to pay your taxes with and all that. So what can we do to make gold provide a yield? Well, just like when you make a deposit in a bank, for example, it's a demand deposit, but nonetheless, there is some risk of loss of your money if something were to happen to that bank or were to have a bank run, like we've seen with some banks earlier this year, the FTX Bank, for example. And if you put that money into a time deposit, like a 6 or 12-month CD, then you can't touch it for that period. So you understand that one of the reasons, one of the reasons you're willing to give up access to your money is to get a return on it, to turn $100 into $105 in a money market or a mutual fund, a simple savings deposit, a CD, whatever it might be. And so we're trying to do the same thing with gold and just say, look, not only is your gold not earning anything for you, it might even be costing you if you have enough that you need a safe deposit box at the bank or that you need a private vault. There are lots of private depositories all around the country. And I would just say as an aside, bank safe deposits are very, very dangerous at this point. Banks have been known to roll over for government officials, even short of a warrant. Banks have been known to allow both state and local officials in to a safe deposit box upon the death of the holder to audit it for estate tax purposes. A lot of bank branches, if you go to your big national chain banks, your B of A's, they're getting out of that business. They don't want to be in that business. There's no money in it for them. And if you read the fine print, oftentimes they are not liable for the contents of your safe deposit box. So, a lot of us, our grandparents had that sort of thing and they considered it secure. Maybe that was a local bank where they actually had a relationship. But that's changed, folks. I really urge people to get out of safety deposit boxes if you have them. You're just as good, I think, in a good safe at home, or if you have sufficient funds or sufficient heirlooms, keepsakes to, you might even consider a private vault. But you're sitting there, you're paying points, you're paying insurance at a private vault, and your gold's actually costing you money. So we're an alternative to that. Maybe you have 1,000 ounces, and at the end of the year, you'd like to have 1,050. If that sounds good to you, it's the kind of program you might be interested in. But really, if this business is ever to become what I think it can become, we are going to have to make that pitch to big institutional investors, big organizations, big trusts, sovereign wealth funds, whatever it might be, that hold far more physical gold than even super high net worth individuals or family trusts or whatever it might do in the West. And increasingly, culturally it's almost a cultural matter as much as a financial matter. Those institutions are in the Middle East and in the Far East. Culturally, gold still animates the culture there in a way it doesn't in the West. In other words, people buy more of it in places like China and India and Turkey. They hold more of it as a percentage of their earnings or of their wealth. It forms a larger part of their estate or, when a married couple comes together. There's just a big difference in how people view gold in the Middle East and the East as opposed to how they view it in the West. So I believe that for Monetary Metals to become a big company, to really scale what we're doing, that part of the world is going to be key to that.
Okay, yeah, but very interesting. And I do want to circle back to the central bank question, but just to finish the other train of thought that I start, make sure the listener understands. So now we're switching. So I think we hit both sides of the leasing element. The individuals physically hand their gold over to you, and then they're being promised, not only to get that back, but a greater weight in return. And then they're relatively secure because it's not that the people you're giving it to are selling it for money, and then we're going to go do some business enterprise, and hopefully we make enough dollars back to go back into the open market and buy enough gold. That's not what's going on. The gold is, you can see it. It's in inventory, and then it only is used to be combined with other things to sell as jewelry, which, as you're saying, if the spot price of gold has changed, that's going to get passed on through to the ultimate buyer of the jewelry.
No.
So that's...
It's effectively being used as inventory, but generally speaking, it is not on their physical premises. Generally speaking, it's at a vault, and they are making transactions as they go. And our leases and also our reporting obligations, we have to have a view into the account at that vault so that we know whenever they make a withdrawal within a very short period of time, a 24-hour period of time, they're replenishing that gold as they go. So the total amount of gold should be about at full throughout the term of the lease, for one. And second of all, they don't, the third party, the company using the gold, does not they use it in an inventory-like fashion, but they don't put it on their balance sheet as inventory. The title to the gold remains with our investor throughout. So it never becomes property of Monetary Metals. It never becomes property of the company using it. It's their property throughout. Much in the same way that if you own an apartment and someone was leasing it, they're using it, but they don't own it. If the property was to be consumed in a fire, the insurance would pay you, not them. If the renter was to declare bankruptcy, they wouldn't include the apartment they're renting in their bankruptcy estate. It doesn't belong to them. So we take the same posture with respect to our leases and the obligations of our third parties.
Okay, great. And then just again, finish the train of thought on the mining element. So is this right that technically they are borrowing from you, like measured in physical gold, and then paying back, whatever that is times the appreciation rate in physical terms. But for them, they are, because they need money, like they're selling that.
You need money.
And then, but because they're a mine, because what they're physically producing is itself gold, that's why from their point, like they're able to, it makes sense from their point of view. Like they are in a sense transforming dollars into ounces of gold because they're a mine. That's what they do.
Correct. And that reduces transaction costs for one. Every time you buy and sell gold, even from a gigantic dealer, refiner, whatever it might be, they charge you a certain premium above, let's say, that day's London fixed rate. So, we're providing them with gold. But a bond's a very different thing. Yes, a miner or refiner generally produces gold and silver as their product. So they can borrow that directly from us. In a bond, unlike our leases, that's going to have a much longer term. That's generally going to be at least 3 years, maybe 5 years, maybe 7 years. That is going to have a much higher rate of interest, oftentimes well above 10, sometimes approaching 20%, depending on the jurisdiction, depending on the company involved. So you're going to get paid a lot more, but your gold is going to be tied up for a longer time. And also in a bond, that's a security. A bond is something where we have to offer that to accredited investors as a security type offering. Your gold does go on the balance sheet of the mine or the refiner in that instance. Unlike a lease, that's their gold and they're paying you back. Just like when you make a deposit in the bank, that's now their money and you're just a creditor. So a bond's a very different animal and a more involved, there's a longer period, but a lot of people will immediately sign up for our bonds when they see that 13, 15, 19%. That does it. And then we say, hey, you have to take into account this is in the mine itself, although it might be owned by a European private equity firm, that the mine itself may be in Africa. There's things to consider that make both the risk and the rate of return higher.
Okay, yeah, that's great. That makes a lot of sense. Again, if for whatever reason it took me 2 passes at it for that all to click, but yeah, the operations where it's gold for gold, that works, and then in the place where they in a sense transform the dollars because they got to hire workers and buy equipment and blah blah blah, so they need to spend money, fiat currency in order to produce physical gold, and so that makes sense from their point of view too. You had mentioned the central banks. So Jeff, I was working on an article for Chronicles magazine talking about the possible future of the U.S. dollar as a reserve currency. And so in doing the research for that, I just went and grabbed the official gold reserves, at least as these countries reported to the IMF, and it's compiled by the World Gold Council. So from the year 2000 to then 2010 to then the most recent in 2022, just to give some background here. So the U.S. has like 8,100 tons of gold all throughout. So there's kind of sitting on it, bounced around a little bit, but not by much. Germany, a similar story. Back in 2000, they had 3,470, kind of bounced around a little bit. It's a little bit lower now. Switzerland actually got cut in half, basically. Japan also, Japan bounced around. It's about the same. UK went down a little bit, but listen to these ones, folks. Jeff, you might already know this. I was just surprised by the magnitude. I knew that the trend was there, but China in the year 2000 had 395 tons. By 2010, it had 1,054, and now 2022, it's got 2,011. So that's like a pretty big jump there. And then Russia, 384 tons in 2000, went up to 789 by 2010, and now they have 2,333. India also bit doubled, but from a lower starting point. Brazil also doubled. So South Africa didn't. So but the BRIC countries, not with the S at the end, a massive increase in their physical holding of gold. So it certainly seems like they're being strategic, and they're viewing that as, they're famously worried about the U.S. using the dollar and its, hegemony in terms of world financial transactions. So I don't know, do you have any thoughts on those sorts of trends?
It's fascinating. I think it's important to look at what central bankers do rather than what they say. And it's clear that these countries are worried about currency exposure. They want to have something that is less volatile on their balance sheets. And unlike Uncle Sam, they don't have the privilege of just producing the world's reserve currency. Unlike the ECB, they don't have the privilege of producing the world's number 2 reserve currency. The Chinese yuan, I think, is in big trouble. And you can understand why they're concerned. Also, Russia, not so much, but the Chinese and other Asian countries have a lot of U.S. treasuries, a lot of U.S. dollars. So I think this is just a sign that central bankers are nervous, and they should be nervous. The total amount of debt in the global economy has more than doubled since the 2008 crisis. It was about 135 to 145 trillion at that point. And by total debt, I mean governmental, sovereign, corporate, household, individual, top to bottom, every kind of debt you can think of. It went from under 150 trillion to over 300 trillion today. So when the whole world has way more debt than it had before the last crisis, And we've had very, very low interest rates for most of the period since then, but they're going up precipitously. The question becomes, how are we going to roll over all that debt and service the interest at much higher rates? And so that's a very scary proposition for sovereign countries, for bondholders. You have the old lower price debt for big corporations, especially the marginal ones that need borrowing to operate. The rich will get richer because companies like Apple and Google and Amazon have plenty of cash on hand. They don't need to go into the equity or debt markets in the way that marginal firms do. Commercial real estate in the West has trillions of dollars of low interest rate debt coming due that needs to be rolled over in a new higher interest rate environment, coupled with the fact that we've got empty office buildings still after COVID. There's a real debt crisis on the horizon. And what's different between today and 2008, other than simply the magnitude and the rising interest rate environment, is that in 2008, even if you had to cut your losses and take your wounds, and a lot of baby boomers did. A lot of baby boomers lost maybe 60% of their asset portfolio. If they didn't hang on, if they just didn't panic and didn't sell, most of that came back by 2011 or 2012. But supposing they sold and they found themselves with only 60% of what they thought they had for retirement, nonetheless, they could just go into cash. And that was a safe play at the time. But today, you can't just go into cash. That avenue is not available to anyone. If you just go into cash, you're losing at least 5% a year, probably more like 7 to 10% a year to actual, real inflation. And so when the very wealthy hedge fund managers of the world, when the very wealthy investment banks of the world say, wow, all these conditions, we're nervous, we don't know what to do, so we're just going to hold cash or maybe some treasuries at this new higher rate, 5%. They have that luxury because of the marginal value of money. If you have $100 million and you don't know what to do, you're nervous, so you just step out of the markets and go into cash. Even if you lose 10% of that in the next year, you've got $90 million. If you've got $100,000 to your name and you say, I don't know what to do, I'm going to go all cash, and you lose 10% over the year, all of a sudden you've got $90,000. Well, yeah, that's a heck of a lot closer to the boat in terms of your family, your mortgage, paying for kids, school, whatever it might be. So that's the difference between the wealthy and most of us mortals, is the marginal value of money. When you have lots and lots of money, you can even buy negative yielding debt and know your losses, and you can navigate that environment for a while. But most of us don't have that luxury.
And this is something I know we've talked about on other podcast venues, but I'm sure you've seen it, Jeff. These memes going around, talking points about how even as everything's is price inflation, even by the government's own numbers, is the worst it's been in decades, and they're showing how real wages among the poorest workers have risen the most. And they're actually trying to say that like this economy of the last 2 years has primarily benefited the lowest quintile of wage earners, and it's so among other. So one thing I think the problem is that they're measuring the wages of people who are working, and so since after COVID, I think disproportionately, it was people with lower skills that didn't get absorbed back into the workforce. That there's a bit of an issue with that going on. Like like in other words, if you've seen charts of average wage rates, they all went up like right into the lockdown period, and that's because they were just measuring the wages of people who were still employed, and that tended to to be, it was easier for people with higher salaries to be zooming in, not if they couldn't physically be there. So that's one artifact, but also to the point you just made, Jeff, that even if it were true, still the effect of like food becoming twice as expensive hits lower income households a lot more than it hits somebody who's making $1 million a year. Like the fact that gasoline is a lot more expensive isn't as big a deal to somebody else. So again, like these, and also just the absurdity. If Donald Trump were in the White House, I'm pretty sure these left-leaning economists wouldn't be talking about how great the last 2 years have been for the lowest quintile. I'm pretty sure that's not the narrative they'd be pushing.
Well, if you make $40,000 a year, living in an apartment with a couple of kids, and your gas and food prices go up, and clothing and other things go up just $4,000 in a year, let's say, that's a huge hit in a way that if you make 500 grand, it's just an irritation. And let's not forget that the housing market is absolutely morbid. At nearly 8% on a 30-year mortgage, houses just aren't selling. They're not for sale. And all these people who are locked in at 3% mortgages, they don't want to sell. And so the number of houses for sale is exceedingly low. It's like at a 10-year low. So what that does is it gives a lot of leverage to landlords, and it forces rents up. And again, that $40,000 a year income, maybe single parent with a couple of kids in an apartment, and they're getting a 20, 30% rent increase. That's a terrible thing. And economists of all people should not be poop-pieing.
Yeah, well, my favorite thing, I know you've probably seen it, Jeff, on Twitter. I retweet it every time he posts it. But Paul Krugman, with a straight face, will post an inflation measure that takes out food, energy, housing, and used cars. And he says, if you take those things out and look at, it's clearly the Fed's beating inflation. So it's, whether or not the underlying statistic is true, but just the fact that with a straight face, he can, and I know where he's coming from in his framework and why he thinks that makes sense,
Yes.
But just that he can say that and not do a double take and catch himself and to say, some people might think I've just taken out the necessities of life for everyone.
Well, it's incredibly tone deaf, but you got to understand that when poor people are viewed as white Trump deplorables, then progressives change their tune. And so poor people are no longer seen as the cause to be championed. They're deplorables who are so stupid that they vote for Donald Trump against their own economic interests.
Yeah.
I think that explains a lot of this Marie Antoinette type moments.
Yeah, they probably like that Oliver Anthony guy. Ha, ha, ha. So.
Yeah.
Well, so I guess as we come to a close here, Jeff, what do you think? I mean, not to have you say a crystal ball here, but like, what do you think about like the U.S. economy going forward? Like you said, you were pointing out some of the differences, even compared from 2008 to now. So I'm just wondering your general view of things.
Well, I don't think inflation is transitory. I think we are going to enter a new era where at least 3% admitted CPI that the government fesses up to is going to be an enduring feature of the economy. And so what I think that means for most people is that you have to think about your ability to go out and earn a living, to improve your skills. That's the best way to keep up with inflation, so to speak. I mean, if you look at real wages, they tend to somewhat track, not always one-to-one, but they tend to somewhat track inflation rates. So right now, one of the big problems of the economy is that inflation has increased far faster than wages. So that's something that hopefully won't last. But nonetheless, you can't trust your house, your stocks, your 401k, all these things that you thought you had are going to be eroded by interest. So I would argue that your number one asset is your ability to go make a living, to earn an income. And so that requires being physically and mentally capable of doing so. So whatever it takes to be in that state and to hopefully be improving your skills, I think is very, very important. I think that the measure of a society is the extent to which average people can save money in safe vehicles. Let's say a simple savings account, a CD, a money market. They don't have to go out and chase yields and try to understand the stock market, going up against algorithmic traders. A measure of the decency of a society is the ability of average people using average low-risk savings vehicles to earn a rate higher than the real rate of interest. To me, a healthy society is one where my grandmother wasn't easy, but it was simple. Just through thrift, through spending less than her and my grandfather took in, could go put that in the bank and earn a rate of interest that was higher than the inflation rate. And as a result, have some money for their older years when they couldn't work and earn income anymore. That's clearly not the case today. That's been flipped at best. And so that's very worrying. That means that average people have to go out there and either work harder, additional job, second job or whatever to keep up with it all, work smarter, get a higher paying job, improve their skills, be in greater demand or whatever. And, that's great. We can all promote hustle culture. We can all promote trying to improve yourself, but average people are not necessarily entrepreneurial. Average people are not going to go out there and start a business. I think there still is going to be a need for many, many decades for a good, healthy job market. And right now, I fear that the next 3 to 5 years is going to be really, really tough. And whether we come out of that on the other side, better or worse, depends on if our reaction is just like the 2008 reaction on steroids. And if we can view COVID in 2020 as any guide, we know that Western governments will go all in, not only on the monetary side like they did in 2008, but also on the fiscal side. So I worry that the next few years are going to be blamed on free markets or capitalism or whatever it might be. And I think one of our jobs as people of goodwill is to try to counter that and to stand up for honesty and decency, because I do think our monetary system is indecent. I think it's immoral. Again, because average people can't simply through thrift save more money than they're losing to inflation. So the answer to that question is more than economics. It's more than persuading MMTers they're wrong or trying to break the Keynesian the neo-Keynesian stranglehold on the Janet Yellens of the world who were basically informed by the Paul Krugmans of the world. I think it's deeper than that. There's a sickness that we all feel. You mentioned that rich man north of Richmond guy. I think he tapped into that. So there's a sickness that's broader than just economics and finances and politics. There's a sickness that I think has been engendered by cheap money and by debt as a lifestyle for 40 years, basically. From 1982 until 2022, interest rates, not just in the US, but across the West, basically went down and down and down and down and down. As a result, people borrowed more and more and more and more. For 40 years. So young economists have no idea of what life was like in a rising interest rate environment. They've never seen it. Most people basically under 50, certainly under 40, have never seen it. So, what did people do when interest rates went down and down and down? Well, guess what? They took fancier vacations. They bought fancier cars. They bought bigger houses. They sent their kids to more expensive schools. Why not? Money was cheap. Guess what businesses did? They engaged in all kinds of M&A transactions using several parts debt to just maybe one part equity. Why not? There was house money on the table. Low interest rate environment for 40 years. 40 years, folks. Has done almost incalculable damage to the social fabric of this country. It's made us worse people. It's made us consumptionists who want to just, live today at the expense of tomorrow because saving is for chumps. And, how we undo that without, first and foremost, a debt jubilee, a big giant write-off, almost of the kind described in the Bible, but also a recalibration of how we issue money and debt in this world to encourage savings and to discourage mindless consumption and mindless debt. That's a big cultural question. That's pretty heavy lifting. And so there's a spiritual element to that that's above my pay grade. But the cultural aspects of fiat money, I think economists ought to talk about more. And I think we all ought to think about more.
Well, yes, some great thoughts there, Jeff. And I do agree with you that it really, I noticed it in particular after the bank bailouts in 2008, 2009, that a lot of like the commercials on, some company would say, hey, the bank's got their bailouts. Now it's time for you to get yours. And, it just became this thing. And, and I always think it was a, quote, harmless ad for something, but it's still, that alarmed me that this is not good, that now everyone's thinking like, yeah, what's the point? Because like you're saying, you feel like a chump. Like I'm playing by the rules and doing what I'm supposed to. That's silly because my competitors, they're getting their debts wiped out or what have you, or you got to invest in this new big thing. And people like, you're right. Somebody hearing your holding up of the ideal of being able to just put your money into a savings account or railroad bonds or something. And they would laugh at you like, oh yeah, go back to the 1950s, man. And it's like, well, right. That was better. It's not that all change is good. So, okay, that's a great spot for us to wrap up on. Folks, my guest this week has been Jeff Deist, now at Monetary Metals. Jeff, thanks so much for your time.
Thanks, Bob. I appreciate it.
And thank you, everyone, for tuning in as always, and we'll see you next time.
This concludes another episode of InFi, The Future of Finance, with Dr. Robert Murphy. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the host and for previous episodes, visit infi, thefutureoffinance.io. Thanks for listening.